Let me ask you something uncomfortable. What if the moment that looks like a failure is actually the setup for the biggest financial move of your lifetime? Right now, if you opened your portfolio this morning, you likely saw red, not green. Gold is down, and silver has been hit even harder. Meanwhile, the headlines are screaming chaos, wars, unmanageable national debt, and geopolitical crises. Every single economic textbook says that when the world is on fire, precious metals should be printing all-time highs. Yet, they are falling. It makes no sense, or at least, it seems like it shouldn't. After 4 decades of watching capital markets move, I have learned one fundamental truth: the trades that build generational wealth almost never feel comfortable when they are forming. They feel like mistakes. They feel like losses. They feel like the exact moment a rational person would walk away. But that feeling? That is the mechanism working exactly as designed. Right now, there are 2 kinds of people watching this market. The first type looks at a declining portfolio and concludes the story is over. They sell, they move on, and 6 months from now, when the suppression phase ends, they will say the same 4 words I have heard after every major crisis of my career: I knew I should have held. The second type understands exactly what phase we are in. They recognize that the very forces temporarily suppressing prices today are the exact forces that historically reverse and fuel the most explosive recoveries. They don't panic. They position quietly, patiently, while everyone else is driven by headlines designed to maximize anxiety, not understanding. By the end of this video, I am going to walk you through a 50-year historical record and explain the structural conditions of 2026 that make this specific cycle far more extreme than any that came before it. Step 1. A geopolitical event disrupts global oil supply. It doesn't matter whether it is an embargo, a revolution, or a shipping choke point closing. What matters is that energy prices surge rapidly, just as Brent crude recently spiked from the mid-70s to over $112 per barrel. Step 2. This energy spike immediately drives inflation expectations higher. Financial markets move faster than reality. Traders do not wait for consumer price index data to arrive. They price in the belief that inflation is coming immediately. Step 3. Rising inflation expectations completely freeze the Federal Reserve. Any previous plans to cut interest rates disappear because the Fed's mandate to control inflation overrides everything else. Step 4. Because the Fed cannot cut rates, bond yields stay highly elevated. When the 10-year Treasury yield sits above 4.3%, a risk-free government bond pays serious guaranteed income with 0 storage costs and 0 volatility. Step 5. This creates a massive opportunity cost for holding gold and silver. Precious metals generate no yield. In a high-yield environment, institutional capital allocators rotate a portion of their funds out of metals and into treasuries. Step 6. Simultaneously, global capital seeking safety floods into dollar-denominated assets. This safe haven flow strengthens the US dollar. Because commodities are priced in dollars, a stronger measuring stick mechanically suppresses the dollar price of gold and silver. 3 massive headwinds land at the exact same time: elevated opportunity cost, institutional rotation, and a surging dollar. Retail investors see the price fall and assume the asset is broken, completely misreading a temporary, mechanical phase. This sequence is not a theory or a speculative model. It is a documented blueprint drawn from half a century of real market cycles, spanning entirely different administrations and economic contexts. In 1973, OPEC slapped an oil embargo on the United States, and oil prices quadrupled almost overnight. In the initial chaos, gold dropped sharply, exactly as the mechanical sequence predicts. But over the following 2 years, gold rose 150%. By the end of that inflationary decade, it had rallied a staggering 2,300%. The investors who panicked during the initial drop missed one of the greatest bull runs in monetary history. In 1979, during the Iranian Revolution, oil production collapsed and prices surged. Gold stalled and gave back ground initially as the headwinds built. What followed was an 89% rise over the next 12 months, while silver made a historic tenfold move from $5 to $50 an ounce. The pattern repeated during the 1990 invasion of Kuwait, the post-9/11 market crash of 2001, and the 2022 Russia-Ukraine conflict. Every single time, the script is identical: initial suppression, a painful bottom that convinces retail investors to quit, and a structural recovery that completely dwarfs the initial decline. The mechanism does not change, it simply requires the patience to look past the immediate noise. First, look at the scale of the debt. In 1973, the United States national debt was a mere $500 billion. Today, it has blown past $39 trillion. In the 1970s, Federal Reserve Chairman Paul Volcker was able to raise interest rates to 20% to break inflation. It caused a brutal recession, but it worked. Today, the Fed is paying roughly $1.3 trillion annually just to service the interest on the national debt at current rates. The mathematics simply do not permit a Volcker-era response. Raising rates aggressively today would completely bankrupt the fiscal system. The Fed's primary weapon against inflation has been neutralized by the debt itself, meaning inflationary pressures will persist and embed deeply into the economy. Second, consider the behavior of global central banks. In the 1970s, central banks were net sellers of gold as the world shifted away from the gold standard. Today, the opposite is true. Central banks globally are purchasing over 1,000 tons of gold annually, marking over 2 decades of consecutive buying. This is a quiet, strategic repositioning by the institutions that manage the world's sovereign wealth. Finally, look at silver's unprecedented structural deficit. The silver market is currently navigating its 5th consecutive year where industrial consumption outpaces mine supply. Because silver is mostly mined as a byproduct of copper, lead, and zinc, production cannot simply scale up in response to price. Meanwhile, the demand side is entirely inelastic, driven by the core technologies of the future. Every electric vehicle requires up to 4 times more silver than a conventional car. Every solar panel, every AI data center, and every advanced defense system requires silver as an irreplaceable conductor. Compounding this, China, which controls roughly 60% of global silver refining capacity, has begun restricting exports. The structural spring is wound tighter than at any point in financial history. The financial media will flood you with noise, daily oil fluctuations, breaking geopolitical headlines, and hourly updates on market volatility. None of that will tell you when the suppression phase is ending. Only 2 indicators carry the true structural signal. Indicator number 1, the US dollar index, DXY. The crisis-driven flight to safety has pushed the dollar index to highly elevated levels. Watch for the DXY to break back below 97. This level represents the tipping point where the dollar's mechanical suppression effect on precious metals breaks down, prompting major institutions to recalculate their positions. Indicator number 2, the 10-year Treasury yield. This represents the concrete opportunity cost of holding non-yielding assets. Watch for the 10-year yield to drop below 3.5%. This will trigger automatically when the debt arithmetic forces the Federal Reserve to prioritize fiscal survival over inflation management. At this level, institutional capital rotation reverses, fleeing fixed income and rushing back into real assets. These 2 metrics encode everything that matters regarding timing in this cycle. When a major market shift occurs, ordinary investors focus entirely on the red on their screens and panic. But serious capital reads the underlying current. You can choose to be reactive to the headlines, or you can filter out the noise, look at the data points, and position yourself quietly. Stay rational. Focus on the macro structure. If you found value in this analysis, share it with those who need to look past the immediate noise, and subscribe for deeper structural insights. Until next time.